August 21st, which means in about a week it will be winter here in Steamboat Springs. Just kidding. If the plan goes as I intend it, I want to talk about this, why we could have a slow bleed in the market. We might not. I'll tell you the reasons why that could occur, and we thought that it could happen based on what happened at the July-August transition. I want to pull up one thing, in fact, while I'm thinking about it here. Then I'm looking at my notes here. I want to talk a little bit about the model portfolio and there's been a lot of adoption of that model portfolio, so thank you for that. Why this time? It's just a catchy phrase. Why this time could be different in the data than the last two tops. And then some mechanics for the model portfolio. And Brian's got some key things to talk about as well. Let me find this item that I wanted to share with you. Bear with me one moment here. I meant to have this all ready to go, and there, this will work. And I got distracted. Okay, that will have to sort of work. Yeah, that will. Okay, now let me share my screen. There. So, this is the Edge dashboard. You veterans see this all the time. If you're new to this, this is the navigational pane. This is what we look at. Brian and I look at this every day. We check the momentum, the low volatility. I like to look at mega caps because it's 75% of market cap. Gives us a pretty good idea right off the bat where things are. And with regard to this notion of a slow bleed, what I meant when I offered this idea back, it's a 3 weeks ago, that we could have a gradual deterioration in the market, and it hasn't really been. You look at where the market is at the moment versus where it was, say, July 25th, about the same. So it hasn't really, it certainly hasn't deteriorated yet. But if you were to wonder why this could occur, or even better, the reason I said that if it happens, when it happens, this would be the reason why. And at some point, it could take a serious leg down, and it has to do with the flow of money behind price and volume. We say the behavior of money behind price and volume is market structure. I'm using this from an email where I shared these data, and it's going to be a little bit small on your screen, I realize. So you might have to zoom in. You can pop the display screen out and zoom in on it. And this is Morningstar data. Morningstar, puts out a lot of great data about the trends in passive investment versus active investment. And these are recent data that look at the top, I think it's the top 10 fund families. And so iShares is BlackRock, of course. And this is in the month. So if you look at BlackRock, State Street, so all the SPDR instruments and so on, Fidelity, which has made a big shift into ETFs, Vanguard, which has done a lot of the same thing, PIMCO, which is kind of interesting. PIMCO is a big bond shop, and this is actually equities. And then the ones that have had outflows, and you look at these. Direction does leveraged instruments, so you will see those things when leveraged instruments are not performing very well. MFS, big fund family that traditionally in the investor relations profession, to which I belong, and Brian does because we have a bunch of corporate customers. MFS is a big stock picker. T. Rowe Price, traditionally big stock picker. American Funds, part of the biggest stock picking complex that is left. And you look at all those numbers and they're negative. You can say, well, add those numbers up, 20, 22, 20, 23 billion. Then you add up all these numbers of inflows. I mean, it's 65-ish, close to 65 billion, something like that, 60 billion plus. Anyway, just a quick look at the math. And so it explains a lot about the market. it dovetails with what we highlight all the time. Look at the behavior that leads. Passive, passive. This is what I'm trying to highlight. Passive. And so principally, these funds are deploying money passively. I actually traded notes with Morningstar yesterday about how active ETFs are being treated. I noted that the number of active ETFs has now surpassed the number of passive ones, but they're not stock picking. They're merely constructing a basket without a benchmark. So you don't have a performance benchmark, and you're not licensing IP from S&P Global or FTSE Russell or the NASDAQ or various others who are big index creating families. And so this money follows a model. Generally, it's pegged to a benchmark. The active money or actively managed ETFs are just constructing a basket every day. Well, that's what our model portfolio is. If it was an ETF, it would be classified as an active ETF, but it's wholly quantitative. We just run a model, and it says every day, here's your selections for today, and here's the stuff you should be out of. So what does that mean in relation to a slow bleed? Well, this money will rebalance at some point. It's fed by our 401ks. We have a 401k profit sharing plan. In fact, we're looking at those things for the end of the year now. What are to be on track with the plan? What do we have to expect for the remainder of the year? Everybody is doing that. Everybody's looking at what do the plans need in terms of contributions to make sure that you're where you need to be? Has it been deployed? Have people changed their allocations? So that will show up here at some point. That money flows into the market and has to be deployed. Then there's the model part of it. If the equity components of the market go way up, then at some point these things have to rebalance. For instance, all of the target date funds that are out there. My generation, and I have them too. It's not the principal thing in the retirement accounts that I've got. The youngsters are using those target date funds more than we are, but they're pervasive. Somebody, an analyst from Germany at Berenberg sent us a paper yesterday or the day before. Pretty interesting data about they're arriving at some of the similar conclusions that we have about how the most important things to follow are how the money that follows these benchmarks behaves and when does it adjust its behavior. So if everybody, to finish the thought, if everybody's overweight because the S&P 500 is up, whatever it is, from the low, 28%, I want to say, pretty close to that, from the low, whatever that was, April 8th, that in these models, if you're going to, you got to hew to that plan that you have to true things up. Where does that occur? It's difficult to say, but they, as we have noted, often find that these things occur at options expirations, which is why we spend so much time talking about it. And the reason it's a slow bleed is because most of these instruments rely on an arbitrage mechanism where Jane Street, a Citadel Susquehanna, is looking at a basket of stocks and making sure that one thing doesn't move too far apart from the other thing. See, so the S&P 500 at one point down 40 points today. It's down half that at the moment, about 24 points. That's all products of arbitrage. When you look across all of the major indices and measures and they're all about the same, that's not rational behavior. It is a reflection of these principles. And so that tends to work itself out in a very orderly fashion until suddenly it doesn't. Because this is the job of the parties who are taking care of that, the Morgan Stanleys and Goldman Sachs's and Citis and Merrills and so on of the world, who are the prime brokers for these big institutional fund families. They're going to make it orderly. I don't want anyone to know what's occurring. It's why when we look at the data, you go, well, there are 2 days where we have net selling, and then there are 2 days where there's net buying, and then a day of net selling and a day of net buying or whatever, and it's very close to the dividing line. That is what's playing out. Now, I don't know. We don't, no one knows precisely what's going to happen. Even generally, what's going to happen is difficult, right? But this is why, and it's very important as investors to understand this. I mean, if you listen to CNBC all day, I just think they spend too much time talking about how it's the, it's active stock picking.
I am
It's
trying to listen to something. Do you
investor
not realize
sentiment
that
and
when
that
I
sort
have
of
these
thing
covering my
that's
ears?
happening. Okay,
It's
so we need
raining,
to
Martha.
mute.
Go watch
Yeah.
TV.
Maybe we can, Brian, you have to find that stuff. You got it? Okay. So coming back. Yeah, that's the best thing to do, Brian. Thank you. Is to know where we are. So some of that's occurring. I think it began August 1. Why? Because we came out of index options expirations July 31st, and it was a terrible day. Then we immediately recovered. Well, that's part of that process. And it can take a long time to move a lot of money. And so, I think that's playing out. Sorry, here, let me go here. So how would we know? I'm going to jump ahead to I think the third thing that I wanted to talk about, why this time might be different from the other two, cycle peaks that we've had here since the bottom back in April. And I don't know, maybe you could even say the last three, it could be different. So here's what I mean. Here was a top in June, right at options expirations for demand, the green part of the graph. And as expected, the prices were all flat. Something I did triggered that. Sorry about that. Don't know what it was. And then you see we had this incredible plunge on the supply side, which then caused the market to defy that demand cycle peak. Then we had another one over the red line. And once again, as we topped the red line, the market was kind of flat. Doesn't mean the market's going to fall apart. And then we had options expirations, and you say, man, demand is declining and supply is rising. The market should drop. But this was options expirations, and everybody levered into derivatives. It's the fastest growing part of the ETF market is what you could broadly call covered call strategies. It's gone from about $40 billion of assets to $160 billion in 2.5 years. Pretty rapid growth. It's a small part of the market, but there's a lot of that occurs, and probably many of you might do this, where you are holding stocks and you sell an option against that to keep the premium and produce a yield from the portfolio. Well, that can skew the market. And so there's the second top. So really 3 cycle tops. Once again, it's 6. These are fairly modest tops. And again, with that, July 31st, there's that big drop. Then we have the market do this. Well, prices are moving away from the demand and supply curve. And it's to me a product of the effort by these large institutional firms to try to rebalance things without people knowing. Because if you know, then you front run it and you pull the market down and prices move away from the folks who are trying to do that. So here's what may be different this time. We're very close to a peak again. It's going to be similar, 6.0, 6.1, somewhere around that level. And now supply is going to rise. So that the difference here is that prices have begun to deteriorate as demand has risen. It's the opposite of what has happened the last 2 times, maybe 3, you could say. And what is different this time? I would point to this. This was the thing that changed. Why we could say there may be a change in the fund cycle. I don't know. It's just interesting to put all the pieces together and say, we think about market structure, demand and supply, the different behaviors that are responsible for how the market works, that most of the money runs on models. 70% of assets at the top 7 managers run on models who are supplying the market with these products. And then the folks who are setting the prices are the Jane Streets and Citadels and Susquehannas, who keep everything closely aligned. But then at some point, that consequence will manifest. I don't know if that's going to happen here, but I could make the case that it could. So now the last thing about the model portfolios, we're tracking the performance has plateaued as it has in the market. We'll watch that. If the momentum portfolio stops working, I don't have it in front of me. We run standard deviation all the time and comparative performance. We look at the focused momentum portfolio, which we're using. We look at a large cap blend of fives, a focus low volatility portfolio, and SPY. And we look at the standard deviation in all of those and the relative performance. So at present, the focus momentum portfolio continues to be the best choice. If that changes, we'll change the model. We'll just get rid of the focus momentum holdings and shift to the thing that shows a better standard deviation and relative performance. And it hasn't given us that prompt yet. We'll keep an eye. Could be that happens ahead. But from a mechanical standpoint, this is the last comment, and then I'll hand it off to you, Brian. This really has to do, I get a lot of questions about this. How do you buy and sell whatever is in the portfolio? So, if you get the model portfolio and it says, okay, here are two things, our two entries today and our two exits today as well. If you're counting on the capital from the exits to redeploy into the entries, which is generally the case, you have a pretty good idea what the market will do. If you've used our analytics for quite a while, you know that the market has, call it 2% volatility. These are momentum stocks. They're likely to have more volatility than that, and they can often be down, and then they recover during the day, somewhere around, they're 9:30 Mountain Time, 11:30 Eastern Time. Around now, things can begin to deteriorate if that is going to be the way things finished for the day, and you can use that to your advantage. I like to, when the market recovers, then I get rid of those things that I'm going to exit, and then I wait for the market to deteriorate a little. If it's gonna, doesn't mean it will, but it's certainly been the case here lately. Then you can pick up those entry positions. I don't put the same focus as I do when I'm using daily trading ideas, where you're very specific about the entry range and the exit range, paying great attention to volatility for risk management. If something is 6% volatile, you got to be able to take 4% risk. I mean, that's because it can move that. And so that to me, this is a yield strategy that works very well. The model portfolios are a longer term. They don't have to spend much effort on it. It makes it very easy. In fact, sometimes I fill positions outside market hours. You can fill a limit order for a small amount like that very easily. Of course, you got a wider spread, so you're going to pay the worst price probably of the day. So you have to realize that that's going to be the case. I haven't noticed that it's made much difference. I haven't noticed any statistical difference in the performance of the portfolio so far. Okay, that's what I've got. Questions, comments?
Tim, there was one question about market seasonality and whether we see that play out in market structure data over time.
Everybody talks about that seasonality. August and September, I realize, are statistically the worst performing months. Okay, what causes that? Is it seasonality? Way back when Brian and I began, because we're both, we're old. I'm older than Brian, so I'm really old. So it was that the traders would go to the Hamptons in the summer, and so you wanted to be careful in the summer. That isn't the case. The position traders are all algorithms today. I think it's much more about the explosion in the passive investment complex, that if you're late in Q3 and you got one quarter left, people make adjustments to their plans. You've got to get square with your risk models, your underlying models and positions, and that's how it manifests. I do think that's comes into play, but is it really, is it seasonality? It's not how I think about it. We just think in terms of market structure.
NL, I think you had a question. If you want to turn your mic on, please go ahead.
Yes, hi team.
Hi there.
I just wonder, when there's a option expiry like tomorrow, um, why sometimes some stocks rally a lot during the expiry day, but some are actually pinned within the strike price, and for instance, like the July Palantir dropped from 140 plus to 142 and
Mm.
rebounds it like next week to history high. What's the rationale behind? How can I observe these behavior during the monthly expiry day?
Yeah, it's a really good question because any answer I give you is going to be at least in part theoretical. Why do some stocks move a lot with options expirations and some don't? I would surmise from that the over-the-counter market is much larger for those than maybe for the rest. Realizing that they're exchange traded options, that's half the market. Then there are over-the-counter options. Most hedge funds are going to use total return swaps, which will be baskets of options, but you're trading straight with a bank, and so you're not going to see that. How would that manifest in the data, at least to some degree? Well, I'll tell you what we always look at internally, is what happens on the supply side around those events. Let me see here. I've stopped. Did I stop sharing? Yes, I did. Here, I'll share one more time, and then Brian will hand it off to you. So if we look at Palantir, could we have known that into August expirations, people were betting generally short versus long? Well, I would say yes. It's not really pronounced, but here's what you look at. You can look at the general trend on the supply side and notice that right after options expirations in July, which occurred right in here, supply is very high. So it would suggest, 60%. So that would certainly say that the bias in that market by the time you get to August expirations is going to be short. Now, it doesn't always work out, but that's something you can watch. And you can watch that same thing around earnings. You go back and look at what happened at the last expirations period that will be nearest to expiring when they report. And that's the best answer I can give you. If there isn't any of that, if the majority of exposure to options just gets rolled, there's not going to be much variance in either the options prices or the stock. And I think in low volatility, let's see what would be a good example. Like take ADP maybe as an example. ADP spending all of its time at 5, probably not going to have much variance, right? This is a platform equity, probably principally owned for its yield. And so you're just not going to see that. You'd say, well, there was this big, move here. Yeah, but it didn't affect price, right? Because it all occurred before options expirations. That's a very short-term play, probably speculative. Can you get a little bit of movement in the options market? Yeah, and it happened. But I wouldn't put a lot of weight on that. There was no movement back here at the July expirations. That's just an example.
Thanks, team.
You got it. Okay, Brad, you had a question. Did I answer that? Yes, it goes out once a day, Brad. I think that's what I saw.
Mhm.
Yeah, it's going to go out. Somewhere around 5, somewhere between 5 and 6. All the data are there. We could schedule that thing. Be very easy to do. We haven't done it yet because I like to check the data. That's all.
I guess one of the questions there, Tim, was whether we could have multiple alerts if the market makes an outsized move. And Candace had a question about creating like edge alerts itself.
Yeah. So you can it's really easy to create alerts in Edge. I don't think about it very often, but you can go into your account and set up alerts. Like, so if you let's do it. Let's go to ADP. Here, I'm just going to do this. And if you wanted to create an alert, I have to remember how to do this. It's been so long since I've done it. I may have to get back to you on that, Candace, because I have not used our alerts in years, but they're there.
I do it from the profiler when I do it. So yeah.
Right. Okay, you could do that. So if I could look up this again, and we could go to profile it. Oh, that maybe there. Okay, you could have done it, but okay, let's go here. So it's a blunt instrument, but you can certainly from here. Is that right, Brian? Yeah. So if you want to create an alert, it will tell you the alerts would tell you about the demand level. That's the basis for creating an alert for us. And maybe that's why I don't do it very often, because I'm daily trading ideas is going to do it for me, as is the model portfolio, and I haven't done that very much. But that's what you could do if you want to know when something is I like the buy the uptick, sell the downtick thing, and that only works with momentum stocks, won't work with ADP. It certainly would tell you when those conditions occur. Thanks for the reminder, Brian. I had forgotten.
Sure.
All right. Over to you. I will shut up and you can take the baton. Thanks, Brian.
Thanks. I appreciate it. I think I'll go through probably two shorter topics today and then kind of look at the kind of the path ahead. By the way, isn't that beautiful? That is in Denmark, kind of like two separate waterfalls there. So I thought that was really pretty. So I wanted to talk for just a moment about the red line. And those who are very familiar with Market Structure Edge, you're familiar with this concept. I won't spend a lot of time on this topic, but you can see right now we're approaching the red line here on our broad market sentiment page. The way I think about it is the market is becoming a little bit overbought or a little bit stretched. It doesn't necessarily mean that the market's about to implode. It does mean that market gains tend to slow down. And you can actually see it occurring here really the last 3 times that we've moved above the red line. Look back in June, we moved above the red line. What happened? Market gains slowed down. Market did not implode. Take a look in July. What happened? Market gains slowed down. What happened at the end of July, beginning of August? Once again, market gains slowed down. We had that one blip lower that Tim had talked about at the beginning of August. Those who are familiar know that I keep this spreadsheet. Don't worry, I don't go through the whole thing. But this spreadsheet goes back to the beginning part of 2020, and it runs through every time that we move above the red line and then move back below it. So for instance, moving above it, January 23rd, moving below it, January 29th. What was the market return during that period? What was the market return during the 2 weeks afterwards? So just to give you an idea, once again, the market doesn't tend to implode. If we look at that time frame, a little bit over 5 years, there's your average for that period. So about 60 basis points. The market continues on average to move higher. If we're in the middle of a bear market, well, there was your average during a bear market. If we're in a really sustained bull market, that average tends to be a little bit higher. That average 2 weeks afterwards, about the same. So when we're above the red line, it's about 60 basis points. If you fast forward 2 weeks later, we've gained about 60 basis points. Are there outliers? Absolutely. There's outliers in every data set, and you can see some of them. Sometimes when we move above the red line, we do have some substantial declines. If you look back in 2020, obviously we got clubbed. 2022, that was pretty bad. We've had some really, really strong returns. This was pandemic trading immediately coming out of the pandemic. You can see how strong that was. You've heard Tim and I talk about April and May trading. Take a peek at that. 12% returns above the red line. We were there for 24 days. That was an exceptionally long period of time. If you look at the norms, there's your norms above the red line, averages about 9 days, about 2 weeks. So couple of the recent cycles have been shorter. Back in June, it was only 3 days. The one in July, very close to the norm. So as we approach the red line, just recognize that gains do tend to slow down, but the market doesn't tend to implode. I'll share with you a new data set that I just put together yesterday. Now, take this for what it's worth, because it only goes back to the beginning of 2024. So it's about a year and a half, not a huge data set by any stretch of the imagination. What this is measuring, it's measuring when big tech moves above 8. So your big tech portfolio, when it does this, when it gets there, that's what I'm measuring. So I was trying to think through, does big tech get overbought at any stretch? And if it does get overbought, what happens to market returns? So you can see over the last year and a half, when big tech went above 8, you can see broad market sentiment at the time. And for the most part, the whole market was stretched at the same time. It makes sense. Here was market returns when big tech was above 8, and you can see it actually differs a little bit from the broad market read. Once again, it's only a year and a half, but if you look at that time frame, we're down about 50 basis points when big tech is above 8. So that does differ from that broad market read that was up about 60 basis points. Now, same read though, in terms of the market does not tend to fall apart. Here's the different returns during that time frame. I took out that one in this data read. So if you take out May, which was really, really strong across the market, 30 basis points. So, you look at it 1 week later, once again, the market does not tend to implode. We still continue to hold on to those gains. Once again, take it for what it's worth. It's a year and a half of data. As I take a peek at the path ahead, we'll start with just broad market sentiment. Once again, we're near the red line. We'll probably get there tomorrow, I would imagine. That means market gains tend to slow down. As Tim mentioned, those gains have already started to slow down. I mentioned Jackson Hole in today's this morning's note. Part of the reason I'm not necessarily concerned about Jackson Hole, but I wonder if market participants, how well they're positioned ahead of it. And I always have to move this screen a little bit. This is a volatility measure that I track. If I want to go long volatility, I'll buy UBXY. And you can see when we have surprises in the market, that was Liberation Day. You have these spikes that occur in the market, and these are huge surprises. This tends to be the norm where you get very quick spikes. If you want to profit on them, and they can be 10 to 15% moves, you have to sell them right away. But you can see volatility has just been absolutely disappearing from the market. So from a volatility perspective, would I say that the market's prepared for any type of surprise tomorrow? No, I don't think so. We look at it from that standpoint, I would say no. If we look at it from a short volume standpoint, in some regards, I would say no as well. Shorts have been generally covered during the last week and a half. Yes, are we coming off of very high numbers? Yes, we are. But you don't see short volumes up at 54, 55%. Market participants are pricing in an 81% chance right now of a 25 basis point cut at the September meeting. And I think market participants right now are communicating that, hey, we expect that 25 basis point cut. And Mr. Powell, you're going to have to surprise us for us to be positioned, differently. A couple things to think about for next week. We'll come up with NVIDIA earnings on the 27th. I forget if it's before or after the market. Number one, in market cap right now, recognize that it can be a market mover. Just, be aware of that. NVIDIA on the 27th. One thing, I'll move this back just a little bit in terms of the look ahead. And Tim did a very great job of describing the slow bleed lower. What can potentially move the market into a fast bleed lower, or the market really deteriorating? When I was looking at the market in February, noticed that it started to deteriorate going into month end, and then that really continued afterwards. Well, I want to share with you one thing that was happening behind the scenes. This is just a spreadsheet that I keep on a few market features. Here's big tech. There's what we were just looking at the end of February. Notice what was happening with big tech. It was below neutral, and that really started to deteriorate. Where are we now from a big tech perspective? Well, we were at 8, we're at 7.4. One other factor to consider, and you've heard me talk about this a few times, I keep track of 2 different short portfolios. On average, those average about 19 names each day. Look at where we are right now. Once again, plays into that lack of a surprise. Market participants are not expecting downside right now. Could it continue to be a slow bleed lower? Sure, but they're not expecting any big surprises at this particular time. So I covered February versus now. Tim, I think that's it. If I were to, make any guesses, once again, I would say market participants are not expecting big downside. We see that with current big tech positioning. We see that with how they're positioned from continuing to generally sell volatility. Could they be wrong in that positioning? Absolutely. When they are wrong, that's when you get the big surprises in the market.
Yeah, you don't see any glaring warning signs like we have seen in the past. The thing that we have kept a close eye on internally that, the team here talks about is volatility, and how the absence of it over time is the threat. I think Brian noted that before this, can't call it tumult, but we've had some challenging intraday moves in stocks, that volatility in SPY had dropped to 28 basis points. And if you think about it this way, that Citadel wants 10 basis points from each side. Well, there isn't much, is there? So that's, to me, the biggest problem, the biggest potential problem for equities is if the parties who set all the prices and want to be there to fill orders don't see any money in it. That's when we have problems. And it's not that bad. You don't look at it and say we're in deep trouble. I'll finish with this. I was just looking at, I like to do it. I look at SPY. It's a good proxy. If you went and looked for this pattern back in time, these patterns tend to precede a decline, but who knows? I don't know what's going to happen. This was a massive momentum market, and then it deteriorates, and then generally the next thing that happens is something more like this. And we haven't had one for a long time. Doesn't mean it's going to happen. It happened. I've looked at data sets like this a very long time, and I have on these sessions noted things that I thought would occur, and they didn't. So you just never know. If you look at NVIDIA over time, what you would conclude about NVIDIA is the same thing that you see in SPY, that you have, what tends to follow very strong demand periods is that it ends. And I hear the people on the pundits talking about exhaustion. There is no such thing. The market does not get exhausted. It just runs out of an imbalance in demand and supply. And so you'd look at NVIDIA now and say, well, it's a really strong period of excess demand that is deteriorating. Now, again, I don't know what's going to happen, but you look at this and say, well, the probability that this resumes is very small. I mean, it could. It just doesn't historically. You could run the entire data set, and on your own time, you can do that. And look at what happens after a long demand period. Well, the market pulls back. And, the simple explanation to me is back to where we started. People get overweight in their target date models, their exposure to equities, and they have to reweight it. And that's where you have these periods like we're in right now. And then suddenly, when that process is complete, and we won't know when it is, you have trouble. I'm not predicting it, but you can look, pick your thing that is a good proxy for the market. And clearly the demand patterns are not great. So we'll see. Just be forewarned. So that's my conclusion. Other than that, everything's fine. Okay. I'm going to be out for a couple of weeks in September. And so those should be really vigorous, interactive sessions with Brian. I'll be here next week, and then I'm out for a little bit. It's sailing in Tahiti time. And that's, it's the thing we like to go do. And we've got a group of friends, and we'll do that. And assuming that we don't expire at sea, I'll see you in the middle of September. But I'll be here next week. So I think that's the 28th. Thank you, Brad. Yeah, it's a great thing to do. Really, really enjoy. Oh, I'm going to be on Schwab Trading 360 Monday at 11:30 Eastern time, I think. So if you ever tune into that, I've done that a number of times. They're really nice people, and no one ever talks about market structure there. So occasionally I'll go do those things. Okay, with that, have a great weekend, which is coming up, and we'll see you next week. Thank you for being here.